Hey folks, this is Big Mike Zlatnik, and I'm recording this right after the Collective Genius Mastermind. I'm back in New York and have some thoughts and comments coming from a mastermind event, meeting with a bunch of real estate professionals who are very active in the space. So many of these folks do residential fix and flip, some rental portfolios, some wholesaling, some wholetalings. And there are plenty of guys and girls who do some commercial deals, some ground up developments in build to rent, build to sell, multifamily, some other asset classes like self storage. And just wanted to summarize sort of a few conversations and my observations just about the current state of the market. So we obviously still living in the period of a lot of uncertainty. New administration. Normally, people preach a lot of change, but change one thing at a time. Trumponomics means change a lot of things at the same time. So that's creating uncertainty and volatility, and we'll see where we'll shake out. But looking at the fundamental picture, had a lot of conversations about buy existing versus build new. And the reason these conversations are coming up is because I was at the event, and many people reached out knowing that I'm a fund manager, and they have opportunities. And most of these opportunities, interestingly enough, were ground up. So ground up multifamily, ground up development of build to rent or build to sell, residential, self storage, multifamily in multiple markets by multiple operators. This was really, really interesting. So most of the opportunities came in the, let's call it, Northeast and sort of a little bit in the South, like Carolinas. So these are the folks I spoke with. Those markets seem to have done well. They have not seen a meaningful correction, and there appears to be significant interest to build new. The problem is raising equity capital has gotten very, very hard with a much higher cost of capital. Interest rates are higher. Cost to construct is what it costs to construct. Although there was an interesting conversation that construction starts have fallen through the floor, and the volume of new construction projects has been really shrinking. And the supply of labor and materials, the pricing of it is softening a little bit, right? We're not seeing massive deflationary pressures at all, but the inflationary pressures in the construction industry certainly have come down. So some discounts are beginning to happen because there are contractors that don't have enough business. So these conversations are beginning to take place. And that's why some of the folks that have been sitting on sidelines talking about building new, but the cost of capital is still high. So as a result, these projects are a little bit harder to pencil. But folks are talking about 40,000 foot picture that the deliveries of the starts today in, call it 2 to 3 years, will be low, and then they'll be building Class A new product into a market that has very limited supply. There's a valid argument to that whole conversation. On the other side, these projects require more reserves, more capital, because the interest rates are still high and they haven't meaningfully fell off the peak. I mean, they fell by 100 basis points off the peak. If you're getting a floating rate mortgage linked to the Fed funds rate or secure overnight funding rate, still the cost of money is less than before, less than last fall, but it's still relatively high. There's some banks that are playing in the space. Overall, still the rates are at the elevated level depending on the type of a loan. So. And the other reason I see a lot of people going into build is because they're struggling to find deep discounts to buy. This is the simplest observation. It's much easier to get entitled land, especially during a period when few people are building. It's easier to pick up a decent deal in land and then build the pro forma and projections to ground up. However, still very speculative, especially when they're delivering into markets with low cap rates when the prices are high. You're basically assuming that the prices will continue to stay high or even grow, which is speculative in nature. On the existing front, I talked to a number of these folks about some of the existing deals we've done, and they can't find these type of deals. They're not easily found a position of existing at a 9 cap rate. So that makes it a lot more attractive. I was comparing and contrasting. When you build new, you cannot do a cost segregation on property that hasn't been built. You cannot get a discount on construction, other than the market could soften a little bit on the cost of labor and material. It costs to build what it costs to build, and you have no cash flow until you build and you stabilize. On the existing, you can buy At a 9 cap, for example, we have a project called Waverly, which we funded a couple of weeks ago. And it's a huge, it's a very deep value buy, very exciting project. 9 cap purchase, cost of money around 7%. You have 200 basis points positive start from the get-go. You have cash flow from day one. You have all kinds of downside protection. Plus, you can do cost segregation and get tax benefits today. So, on the comparison sake, it's easy to see that existing, if you can get a deep value buy, significant discount, they present significantly more interesting opportunity, at least in my book. And many folks agreed with my position and said if we could get these type of deals, we would. The challenge is they're hard to find. So it requires special relationships, a lot of work. At the end of the day, to get these type of deals in volume is very hard. One off here and there, they're great opportunities. But volume is not something you get every day. And that's true. We haven't seen a deal like this in a couple of years. That's why it's a precision, it's a surgery. It's not, throw a lot of things and see what sticks on the wall. That's the construction business, new construction. The execution on existing buys is a precision target shot or surgery precision cut. So for compare and contrast, in limited volume, existing is a much better opportunity today. And if you have no existing, then the only option you have is to consider new construction, again, if you want to play in that space. Of course, many investors have also gravitated to more conservative investing, private credit, lending funds, funds that focus on first lien loans, maybe some mezz debt. Those are more defensive strategies versus typically new construction or common equity in existing. But again, common equity in existing on a deep value buy could be incredibly attractive because of those elements that you're buying well below reconstruction cost. That's another critical consideration, is how much of a discount are you getting versus new construction. And of course, you can discount for the age. But then if you're renovating the property and sprucing it up, and as completed by post-renovation, your cost could be significantly still below reconstruction cost. Then you have a almost new product or close to new product, and you can charge rents based on renovated product versus new construction. So these things, they go through compare and contrast, and there's no right or wrong. Both of these opportunities are valid. So investors really facing today in real estate, be a lender, invest in lending funds, continue to be conservative, first lien, mezzanine debt, both are phenomenal strategies. We implement through Tempo Income Fund, primary lending, some mezz debt, and then we have Tempo Advantage Fund where we loan and mezz debt. And then on the equity front, deep value deals like Waverly present great opportunities. We're looking to bring another phenomenal deal to the market in the May-June timeline, also on a deep buy around 9.5 cap. Stay tuned if you have interest. Right now, the project is in a secret phase right now, but we're working on this. So it is yet to come, but this is not a volume game. This is a few specific precision projects that present phenomenal opportunity. And for those who want to move directionally in a given market with new construction, these projects exist. I certainly was approached by multiple players, good cats, very experienced builders. They're struggling to raise capital because a lot of investors are still skittish and very careful. Is this the right time to go with new construction yet? But they believe it is, and they just got to find the equity capital, which is a little bit hard in this environment. So that's it. Just a quick summary on my CG trip. I had a bunch of conversations with great folks, operators, also many investors. They literally said, bring me more deals like this. Many of them have already written checks into Waverly, and they will want to be on our list to look at these deals. Many of those guys are REPs, so they love deals with heavy depreciation. We'll continue to bring those. And then some deals will have a little bit less depreciation. They'll just be great cash flow deals. In this environment, my view, everything is focused on a cash flow. Not only I want a great appreciation and growth, but I also want the cash flow today. And we can accomplish it through these deep value buys like Waverly as an example. If you want to learn more about that project, reach out. Again, it's closed. There's no more opportunity in the deal. But as an example, you could take a look to see what a great deal looks like today. Thanks for your time and attention. Until the next time.